Hi, this is Nolan Sampson, Director of Business Development for the Halderman Companies. Appreciate you joining us for the 2021 Maximize Your Farmland series. Today, we've got Howard Halderman talking about land values and rental rates, and we'll also have David Widmar. David joins us from Ag Economic Insights. He is an agricultural economist specializing in ag trends and the farm economy. Through his research, he supports agribusinesses and farmers in their strategic and planning efforts. David's work can be found at Agricultural Economic Insights, which we will flash on the screen in a little bit. Housekeeping today, if you have any questions, please send those directly on the chat and I will take those. I will send a message in a few minutes, but with that, I will have Howard take it away.
All right, thank you, Nolan. Appreciate the opportunity to talk with everyone today. As you are probably aware, this is decision-making time, or decision-making time is almost upon us as we think about cropland and farmland in the Eastern Corn Belt. As we get to the fall of the year, if you're going to change your lease rates or your lease type for 2022, you kind of start thinking about it in August, September to be implemented after harvest. Likewise, if you're thinking about maybe, is this the year to sell the farm? Historically speaking, most farmland is sold off season, meaning that it's sold in the winter. So a lot of folks are thinking about that kind of decision, and we'll talk about whether or not today is a good time to do that. So again, thank you for joining us. We're glad to have you online, and I will have this, at least my PowerPoint will be available for anyone who would like it. So afterwards, if you would like to email us or let Nolan know, give us your email address, I'd be happy to send a PDF of it to you so you can share it broadly. There's nothing in there that is anything that I would call revolutionary, so happy to make that happen. So with that, I'm going to share my screen. Are you seeing it? There we go. All right, so some of this data you're going to say, yeah, if I've listened to Howard before, this would be somewhat similar. Hopefully everything is updated for as close as I can get most recent reports. For example, the Federal Reserve Bank just published their information for July last week. So we try to keep this stuff up to date. Farmland doesn't change that quickly, and when we do these quarterly, it tends to somewhat be repetitive on a few points. But with that, who is Halderman? We're a 91-year-old company, been based out of Wabash, Indiana for the entire time. My grandfather there in the middle of the screen started our family business. And today we manage farm properties, we do farm appraisals, we do farmland brokerage. All three service areas we provide to anyone who has some ownership or influence over farmland. And again, it's farm oriented. We don't deal in commercial, industrial, residential, that's not us. Yes, we sell a house from time to time on a farm, but most of the time we're working on farmland and we work on it across the United States. You can see here the farm management, sales, and appraisal business that we do. A lot of appraisals we do are for loan purposes or estate planning in some instances. So have a team of certified general appraisers on staff to handle that, in addition to all of the real estate brokers who do the management and the real estate sales. So you can see here at the bottom of this slide, average tenure of our staff is greater than 20 years. So I'm going to talk about some information from them today, and it is well-founded with a long history in their area. They know their areas well, they know the people well, and so when you look at the information they're providing in these slides, it has a lot of value, in my opinion, because of that long-term tenure. And we don't just work in the Eastern Corn Belt. We handle properties all across the United States. So do have some familiarity around the U.S., but you can, most information we're sharing today will be in the Eastern Corn Belt. So farmland values are strengthening. We certainly have noticed that over the last 12 months. And in the farmland real estate market, there are few outside drivers of farmland sales. You probably have noticed that the number of farms for sale, if you're looking at the Farmers Exchange or Farm World, the number of farms for sale have picked up over the last few months or maybe month or so. That would be normal. This time of year is when you start to see more farms come onto the marketplace. But generally speaking, there have not been any outside drivers of farmland sales since 2012, which was a time period in the fall that Halderman was auctioning 4 properties a week for, oh gosh, 3-4 months at the end of the year, largely because most people were concerned that capital gains tax rates were going to increase. And at the time, it was assumed President Obama would win a re-election. He did, and that we would have a heavily Democratic Congress. Now, capital gains tax rates never really changed, but it was just that fear that they would that really spurred a lot of people to want to sell. Well, we really haven't had any kind of outside driver, tax law change or USDA program change or anything major to change that in the last 8 years. Now, I put maybe on this slide because we could be entering a time period as the House starts to take up the infrastructure bill, depending upon how they choose to pay for that. If they enact some tax law changes, that might be some motivation for people to think about selling. Why would you do that? Well, let's put it this way. If Congress were to change the capital gains tax rate from the current 20% rate to maybe back to 28%, like it was prior to the current bill, that's 8% more on any capital gains that you may experience. Well, if I'm thinking about selling my farm in the next 2 to 3 years, might I want to do it in 2021 versus 22 or 23? Maybe so. First of all, you're at the all-time high level of farmland values. And then secondly, you do know that your capital gains tax rate as of today, August 23rd, is at the 20% rate. So some people are telling us that's their thought process. And so there may be a little bit of an outside driver of tax law change that we're seeing this fall, but not a huge number of sales out there yet. Cropland values have been stable for the last 5 years, but for the last 12 months been moving up, and I put 14% in parentheses. That comes from the Purdue survey that was done back in June. Also, the Federal Reserve Bank is going to show similar numbers to that. And so that's a pretty dramatic increase. So you have this stable marketplace for 5 years, and now we've seen this big jump up. It really started last August when commodity prices started to jump up due to the derecho event out in Iowa, followed by increased demand from China and higher commodity prices. Now, one of the things that benefited us from COVID, and there weren't a lot of benefits, but one in the residential, or I should not residential, but the rural landscape, is that all of a sudden we saw some people interested in living in more rural areas. That was a change in the demographic trend that had existed for the past 20 years, where a lot of folks were trying to move into more of the Indianapolis, Chicagoland, Detroit, Columbus, Ohio, those kind of communities, because of the cultural opportunities that exist and employment. Well, with COVID and the ability to work from home, that kind of changed. And so we've seen timber values, recreational values, rural residential values increase due to low interest rates and the demands put on from the COVID. So as I alluded to earlier, here's the Federal Reserve Bank report. It just came out last week. And from July to July, they're showing that the entire 7th district is up 14%. That would show Indiana there at 12% year over year. Moderate increases, but in the last quarter, but certainly a 3% increase in a quarter is a pretty substantial increase in farmland values. So these are all the agricultural lenders that are FDIC, work at FDIC insured banks, and they're providing this data. For whatever reason, Michigan did not report. That's why you see nothing there. So I don't want you to believe that Michigan didn't change. I would say it probably changed pretty similarly to the other states in the survey. Here's the Purdue Farmland Values survey. And I want you to kind of note, the nice thing about this is it goes back to 1975. And it shows you the high in 1981. It also shows you the high in 2013, and then where we're getting to here most recently, which is back at that all-time high or pretty close to it. And notice the jump in farmland values on this slide versus what we'll look at in a few minutes on land rents. Land rents went up a little bit for 2021, but not near as much as what farmland values have done. So we're back at that all-time high, as I alluded to earlier, based on this Purdue survey. Now, this is a survey of farm managers, farm brokers, farm appraisers, as well as those ag lenders that I mentioned earlier. Those are the folks that contribute to this survey. And again, that was done back in June. So a third way to think about land values, and those of you that have joined us before have heard me talk about the WAPI analysis that we use, but you can take any soil in Indiana, Ohio, Michigan, Iowa, Illinois, and within that state, you can compare farm to farm based on the soil types. And each of the soil types is rated for its ability to produce corn. And that rating looks something like, well, a Brookston soil type might be rated at 160 bushels per acre of productivity. That doesn't mean it'll actually produce 160. In fact, I would argue this year that that number will be well above that for Brookston soils. But that gives us a way to compare one soil type to another soil type, and you can average them for a single field. Well, if you have a farm that has a 150 bushel productivity index, and it sells for $8,000 an acre, you can do the math and come up with so many dollars per bushel of productivity index. And I show you this first slide back in 2013 at the previous all-time high, we were in the low $60 per corn bushel of productivity index. So in other words, if you had a 100 bushel productivity index farm, the indicative value of that would be $6,200. Now, there were farms selling for $12,000 an acre back then, but 100 bushel productivity index is pretty low in the state of Indiana. So that's why it would only be worth somewhere around $6,000 an acre, or maybe even less in certain instances. So this is really a trend to show you where we were in 2013. We look at where we went to in 2014, which was kind of the crest, and then we started a downturn in 2014 due to lower commodity prices, lower farm incomes. We got down to, in 2015, we jumped back up above 60, but then quickly eroded down to $50 per productivity bushel. And then we basically sat there for the last 4 years or 5 years. And right at $49 to $50, $51, you can see that red line slightly increases over the last 5 years, but it's been a very sideways market. Now you'll notice all the blue ups and downs. That just is, those are all sales we did. Those are Halderman conducted sales. So we know exactly what they brought. And you can see the variability. And that exists anywhere in farmland because every farm is unique. Every farm is different. And so without a lack of consistency, I talk about the trend line, but you see a lot of variability from farm to farm. So then we look at 2021 and what have we done? Well, we've been at 50, trending upwards. I would argue today for the better farms, we're well above $60. Now, this is through Q2. We didn't do a lot of sales because traditionally not a lot of sales occur in June, July, and August. We have 4 sales this week, Monday, Tuesday, Wednesday, Thursday, and nights. And I would suggest that we'll probably look at values that will be well above $60 as we go through these 4 sales. So I would look for this trend to really steepen as we go into the latter part of the year, based upon some other feedback that we've seen from sales that have been conducted in other parts of the Midwest. Here are just some farmland sales that we've done since November. This just goes back to last fall, so about 9 months ago. And you can see even back then, here in Wabash County at $60, Rush County at $62, high 50s. There's Bartholomew County. Now that's $5,700 an acre, but it brings $64 a WAPI point, probably because it was a smaller piece, but pretty low WAPI score, I'm imagining. Here's a $92 a WAPI bushel down in Fayette County, 60 in Miami County. So you can see the values have been pretty high as we've gone through the last 9 months. And then not a lot of sales. Here's 240 acres in Wells County, ranged anywhere from 5,900 an acre up to 10,000, 15,000 an acre down in Hamilton County. So I didn't put a WAPI analysis on that because it would be inappropriate. Something that kind of sold in 240 acre blocks, brought $15,000 an acre. One of the pieces is over 20,000 an acre. Clearly that has more development influence. We've had a number of private sales that have occurred before the auction was actually advertised. And so that has been a trend that we've seen this year and just tells me that the market's pretty strong. So that's the WAPI analysis. One of the things I would suggest to you, if you haven't done it yet, you might want to download the Halderman app. The beauty of this is it will allow you to see our sales results live as they happen later this evening and the next 3 nights. So this is something for you to download and get ready so that you can look at those results and see how these farms are selling right up to the minute. Now, I did a survey. This was back in March. Admittedly, it's a little old at this point. In fact, the survey data for this September is coming in right now. I do this in March and September. And but you can see the trend was all up for cropland, woodlands, rural building sites. Really, the only weakness was in livestock facilities, which livestock haven't enjoyed quite as much fervor as what the land market has over the last few months. But pretty good change in values in our opinion. These are just opinions from the Halderman staff. I asked about number of sales, and you can see 80% said fewer number of sales in the last year than what we had the previous year. Dominant purchasers in the land market, heavily farmer, about 60%. If you look at our actual sales data, it would mimic that and be in a 60-40 split between farmer and farmland investor. Here's the Purdue Ag Barometer. I don't know if Dave will get into this or not in a few minutes, but this has, up until the last few months, really been pretty indicative of the farmland market. And you can see here that it got pretty high. This scale is 0 to 200. So if, in theory, if you feel average, it would be 100. And you can see the first year of this back in 2015 hung around 100. We've been above that at every point except for back at the height of COVID a year ago when it went below and dipped below 100 for a brief period of time. But really, the farm space, farmers by their nature are optimists. They may not communicate that always. But if you're going to plant a crop and really count on God to give you the rainfall you need and the sunshine, you got to have a degree of optimism in you. So this tends to always be above 100, but it is a good way to look at the ag economy barometer. You might say, well, Howard, why did it drop to 137 and 134? Purdue does this survey. They ask 400 producers from around the United States, not just Indiana. And the feedback they received was 2 things. One, the potential tax law changes really had farmers concerned. And so that's why their view on the ag economy kind of scaled back. The second one was they were seeing larger increases in input costs, seed, fertilizer, fuel, equipment, all those things that go into producing a crop. So while commodity prices are really excellent today, very profitable levels, the concern is that going forward, we've incurred some increases in input costs, and we have to hope that commodity prices stay where they are. Otherwise, $4 corn, for example, may not be profitable where it had been in the past. So I think really input costs and tax law changes were the 2 reasons for the drop, not because they thought land values were coming down at all. So let's talk briefly about debt. Believe it or not, real farm debt, and this is inflation adjusted, is back near the 1980 high. And it's really more real estate debt than it is non-real estate debt. So that could be concerning, right? Because that's when we got into trouble back in the 1980s with so much debt. Well, it would be, except that farmland values are dramatically different than they were back then, if you remember the Purdue chart, and this issue. So this comes from Dave's group, AEI.ag, but the average interest rates on non-farm real estate loans, you can see how low they've gotten. Well, compare that back to 1981 at above 18%. So that leads to this. Interest expense, dramatically different. So while debt, the blue line, is very similar to what it was in 1980, the interest expense is half. And that is a huge issue. It's a positive for ag. It's also a big positive for the federal government, between you and me. That's how they are able to subsidize all this debt to some degree. Here is the solvency ratio. So debt to equity and debt to asset ratio, both relatively low. This is where I talked about the debt being at that high level, but because our land values are 2 and 3x what they were back in 1980, that debt to equity and debt to asset ratio remain at a pretty low level and a pretty safe ratio today. Now here's debt to income. This is another analysis you can use and take your total debt divided by your farm income. And the concern is when this goes above a 5, which happened in the late 1970s and then continued into the 1980s. And that's when it became a real problem. And we had all of the farm aid concerts and a lot of farms sold because of bankruptcy. Well, we were approaching that level, got up to a 6 a few years ago. And that really, I think this chart really shows why we were in that sideways channel. But the last couple of years have been more positive. Income has come up. Debt hasn't increased more than that. And so that's an improving sign. And then here's just to give you an idea, the share of farm loans delinquent, relatively speaking, going back to 1991, average. Here's working capital. Now, this one is more of a concern for me. Again, this comes from Dave's work, and I may be stealing a little bit of his thunder, hopefully not. But you can see working capital, which is the big concern out there, really got eroded the last 6 or 7 years, down to a 12% level. I'm guessing, Dave probably has an updated slide on this, that number has jumped up for 2021 to a more healthy level. And I don't know how high that's gotten, but that has probably jumped up due to the higher commodity prices and the government support. And here's another way to look at it, real working capital. So you compare the cash that existed on the farm back in 2010, 2011, 2012 to where it is today. That's a significant change and puts more people at risk if we got into a real negative income situation. And then bankruptcies, I always like to show this because of headlines 3 or 4 years ago. You know, the Wall Street Journal had Chapter 12 filings were double what they were in 2008, 10 years ago. This is 2018. And so I did a little research because I thought initially, I said, well, 2008 wasn't all that bad a year. And it wasn't. Chapter 12 filings across the United States, 250. So yes, in 2018, they were double at 500. Well, let's compare that back to 1987, folks. And look, it's a fraction of that. In fact, it's less than 10%. And in 2020, the Chapter 12 filings were at 552, which is still less than 10%. So it was a decline from 2019, still above average, but not really a concern like we saw in the 1980s. So where do farmland values go from here? It really depends on 3 things: incomes, interest rates, and supply. We'll talk about each. We'll start with incomes. Incomes were really good back there in the 2007 to 2013 time period. You saw, remember the big working capital boom and build. Then we've had lower farm incomes through 19 and a cash drain. Government support has been absolutely critical, and I'll show you that here in a second. Interest rates still historically low, and I've got a slide on that as well. And then the farms for sale remain below normal. So where do land values go? Farm incomes are up. I think this year you could see a number of farms make $900 to $1,000 an acre gross. Indiana, I think the Pro Farmer Tour was estimating the yield at 198 bushels per acre. If we make 200 times $5, which $5 is a possible price, that equates to $1,000 an acre gross. Now, not everybody's going to sell for $5. So if you sell for an average of $450, that's $900 an acre gross. Both are profitable. You can look at the production costs that our staff estimated prior to the year, including rent, in that 700 to 800 range, let's call it. So clearly $900 to $1,000 an acre can be profitable. Demand is up for rents, that's for sure. Farm incomes are up. Now, they actually were higher, projected to be higher in 2020 than what they are in 2021. And that is purely a reflection of the decline in government support via COVID relief or the market facilitation payments. So let's talk about that. Here's the impact of USDA payments. You wonder about that cash that's available out there. Yeah, 2020, all-time high. This is inflation adjusted, all-time high levels of support. Let's look at it another way. Again, Dave, I may be stealing some of your thunder, I don't know. But direct payments, a huge part of the farm income picture. So farm incomes in total are pretty good. But a lot of that comes from the government support. If you look at just the blue part of those lines, the net farm income has been kind of sideways. Now here's real net cash farm income less the government program payments. And so when you take inflation out of adjusted, it actually shows a decline. So that's the impact of USDA payments, impact of trade. I'll briefly mention this. I think a lot of people, and again, Dave, you're probably going to talk more at length of this, but here's US or Chinese purchases of US soybeans went away when we had the trade war and now back in a pretty robust way. And then corn the same. Timber values. Yes, we do sell farms that include a lot of hardwood timber on them. And you can see here that those values have been creeping up. And I view that as positive for the rural landscape, especially in Indiana, Ohio, and Michigan, where timber values are part of what we sell on a regular basis. And so that's been a positive when you talk about recreation or timber values or wooded land values. Cap rate can be important to some financial investors. You can see based on the Purdue study that the farmland cap rate actually dropped because we had a bigger increase in land values than we did in rents in 2021. We're going to talk about that here in a second. Farmland is worth what it brings. And so we're going to talk about some rent results. You know, Halderman's rent results from negotiations over the winter. And you can see that honestly, pretty steady. Maybe 3 of our staff raised rents. Did you lower any? One person said they might. But that key statement there, negotiated too early, is what I really want to point out to you. A lot of rents were negotiated in October, November of last year. And that was before a lot of the big run up in commodity prices. So when you look at the Purdue survey here in a second, that's going to show more of a muted increase in cash rents. That's purely due to the fact a lot were negotiated in the fall and not in the winter. Supply of farmland for rent, 21 versus 2020, pretty much the same, not a lot of turnover. Was the demand up? It certainly was stronger for rent coming into 2021. I would anticipate the same results for 22. Did we have any tenants default on leases last year? No. Will tenants give up their leases rather than renegotiate? In fact, we had one that did. Again, last fall, winter was a little different times than what we are today. Here's the Purdue survey that I mentioned. And if you remember the land value chart showing that more of a hockey stick move up, this one doesn't show that. In fact, we're not anywhere close to the cash rent all-time high on the best land. Now, average land is pretty close to its long-time high, and below average land is above it. So as you think about cash rents, as you think about how you want to negotiate it for 2022, this is a year that argues for the cash flex lease. If you had a cash flex lease in 2021, that's a base guaranteed rent with some ability for a bonus to be paid if it's a good year. And I would argue that 2021 is probably going to be a pretty good year. Indiana, Ohio, Michigan, and Illinois are looking at, generally speaking, good crops. Not every farm, I get that. But most of the area has really good crops this year, combined with better than average commodity prices. So we could be looking at some nice bonuses paid on top of that guaranteed rate. And by having that cash flex lease, those leases are going to be more equivalent to what land values did this past year. So do you want to look at a flex lease for 2022? You might want to consider that. Or how do you increase your current fixed rate? And what's a fair rate of increase? Is $5 an acre enough, or should it be 25? And that's really something that the Halderman folks can help you answer. Any of our area representatives understand each of their areas really well. So if you have questions about what's the right rent for my farm, what's the right rental structure, our staff, that's what they do. They do it every day. They do it on 40 to 50 farms each. So they see a lot of they understand that marketplace better than anyone else. So I would give one of them a call. And if you don't know who to call, reach out to Nolan or me and we can get you to the right person. So here's the ending, kind of my summary as to where we're going. I think that farm real estate in 2021 is well positioned. You got long-term world demand fundamentals. That Chinese trade demand has been pretty good. We got to still double food production by 2050. You have just-in-time delivery. You know, there used to be a storehouse of grain and a lot of grain bins around the United States, and that just doesn't exist anymore. So as a result, you get this basis swing we've been in a very positive basis territory all summer here in Indiana, and that historically is pretty unusual. Interest rates are still very favorable. In fact, I looked at the 7th district rate here this last quarter, 4.02%. I've left this statement all the same, except I've changed the percentage, because every quarter it's the lowest ever, because that number keeps coming down. That's pretty reasonable money, if not cheap money, for long-term financing on farmland. Supply of farms for sale remains lower for now, but that could be increasing. And then what's the government support going to be in 2021? I wouldn't suggest much, except for what the annual programs PLC and ARC might offer, which again probably won't be much. So is cash increasing? And I would suggest to you, I think that it probably is. Cropland values are in an uptrend. How high they go, we don't know, but I think you could see another 5% this year on top of what we've already experienced, maybe 10 in some locations. Timber, recreational, rural residential values all steady to stronger. The big thing that I think will be interesting to watch this fall will be, what do those average to below average farms, those hassle farms, something that has a drainage problem, something that's a bunch of little fields, does that really get separated and see a bigger spread in value from the best land that exists out there? I think that probably is the case. That's what we've been seeing the last few years. And I bet that gets exacerbated here this fall. So I'm bullish. I just said that, and I'm bullish for these reasons. We're looking at profitable prices, low amount of debt, low interest rates, and a low supply of farms for sale. You add all that together, and that's going to be bullish for farmland values. Biofuels, the word I got this morning is that the RFS, the Renewable Fuel Standard, just got sent from EPA for analysis by the Budget Office in Washington. Let's see where that comes out. But that biofuels demand is remaining fairly low, but kind of steady and moving along. Hopefully that remains in place. You got world population growth. Trade deals are certainly helping. And then you got this potential for inflation. Anybody heard the word inflation out there? Farmland is very positively correlated to inflation. So if we get into inflationary times, that tends to lead to higher land values for farmland. Land value bears, if you want to argue the other side of the equation, here are some things you could say, well, what will the Delta variant do? Is that going to crash commodity prices like it did 18 months ago? Maybe. I doubt it. Weather impacts. Well, we're kind of almost to the end of the growing season. Not a big impact here. The bigger thing will be what happens with global production in South America this fall. And what kind of weather do they get, and how big of an expansion in acres do they have in corn and soybeans, which would cause our commodity prices maybe to lower. The worldwide economy tanking, that would lead to lower demand. Trade agreements or not. Those are things that are question marks and concerns, and definitely items to watch, but I remain more on the bullish side. And you got other asset classes. There are some financial investors I've talked to, institutional investors we work with, that have said, yeah, but look at the stock market, all-time high. I'd rather have my money in stocks because they did 20% this past year, and farmland only did 17. Because if farmland values went up 14 and they made a 3% cash yield, that's a 17% return. Their choice. But certainly farmland is not really comparable to equities. It's more of a fixed income. And so when you start to compare it to what you can do treasuries or CD rates, farmland looks pretty appealing. Working capital concerns, I think those are over for now. So to conclude, I'm bullish. I think the fundamentals are there. Higher prices equals more demand for rental land. Higher rents usually tend to lead to higher land values. So that's where I'll conclude and turn it over to Dave at this point. Nolan, do we have any questions we need to answer?
No questions so far.
Okay, so as a reminder, don't hesitate to jump into the chat box with a question if you have one. I know I went very quickly, but we want to keep this to an hour, and we want to make sure Dave has time to get his presentation in. So Dave, take it away.
Well, thank you. It's great to join you all today. Really appreciated following Howard. There is a lot going on, and I want to add, I guess, my 2 cents worth. And it's to start this off, to kick this off, I'll tell you a little bit about AEI. We started this several years ago. Dr. Brent Gloy, we were both at Purdue, and we wanted to provide, I guess, insights for thought leaders, people who are making big decisions for their organizations or for their clients and their customers. So we launched AEI. There's a free weekly article we provide. We also have a premium side of our website where we have 3 or 4 really good articles a week. And I want to mention Escaping 1980. That's a podcast that we launched last year. And we really, Howard mentioned a lot of the struggles that were going on in the 1980s, but we tried to capture that in a story. My co-founder, Brent Glenn, and I, we're both economists, and we wanted to tell something that wasn't an economist speak. So we had a great journalist who came on to help us tell that story. And I'm sort of talking that up because we have to remember what we were thinking about a year ago. And we started working on Escaping 1980 a year ago. And the question we were getting a year ago was, is this a repeat of the farm financial crisis? And there were a lot of things that rhymed. There were a lot of things that seemed familiar, and we wanted to cover those. But by the time we finished up Escaping 1980 and we got to the end of this, we were nowhere near that 1980 scenario. There was an entirely different sort of theme going on there. And just to sort of get into our time machine a little bit, let's think about where we were. Let's start the clock back in January 2020. There was a lot of optimism back in January when we signed that phase 1 trade agreement. And you can see in the barometer there, I kind of circled 2020, and you can see sentiment really shot up as we head toward that trade agreement. And then we got to March and April, and the pandemic took off. The USDA thought we were going to plant 97 million acres of corn. We didn't do that. We had a fairly big prevent plant situation in 2020, not as big as 2019, but still historically significant. Of course, we also had commodity prices across the board tumble. And of course, it was the end of the end of April that oil prices traded negative. We actually wrote an article on our website trying to outline why we didn't think corn would be as susceptible to trading negative as oil. There's a lot of differences there, but people were really worried about that. By the time we got to a year ago, about this week, a year ago, December corn futures hit $3.20 a bushel. Producers were really scratching their heads looking at, are we going to have a 2 in front of our cash prices? Chinese purchases all summer last year were not just lackluster, they were abysmal. They were on the slowest pace that they had ever been going through August. And we were fielding all sorts of calls saying, when is the USDA going to release this CFAP 2 program? They had a CFAP 1, which was really grain in the bin back in the first weeks of the pandemic. And they promised something in June or July, but it wasn't until August or September that we actually saw this second round of government payments. It didn't come until September. And then, of course, things turned around from the end of August to the end of September. You couldn't have expected a much dramatic turnaround in the farm economy. And you can see that in this data in the Ag Economy Barometer. Commodity prices started their rally in September. The USDA started shaving off some bushels. CFAP 2 payments hit the producers' mailboxes about a week after that. And then, of course, China started buying, and they bought big. We're going to talk about that in a few slides from now. But the grain stock situation went from extremely burdensome to very tight in about 6 to 8 months. And, of course, this sent everything higher. So the point I want to make here is not only did the farm economy have an improvement, the improvement was from very pessimistic to very optimistic. It was a wild shift in the nature of it, but it also happened in a very, very short period of time. So we've been using the word whiplash to describe this, but everything changed really quickly in a really short period of time. Now, one of the things that we talk a lot about is where are we in the cycle? And cycles sometimes get people thinking about time frames, and that's not what we're trying to do, is not time cycles, but think about where we are with the temperature of the room. Where is sentiment? Where are producers thinking? And where we were last summer is producers were really looking at their budget saying, how are we going to keep costs under control? How are we going to manage this thing? And now everyone's starting to wonder, are we in a boom? Are we starting to see this expansion? One of the things that happens during booms or these periods when there's a lot of demand that comes to the forefront is commodity prices get really strong. And we've seen that for about 11 months now. Now, the best way to know if you have a boom is the rear view mirror. But we can start to look at some of the data we have in front of us now to understand what's going on. And I want to point out some stuff that we see from around the globe. So this chart right here are world harvested acres. So this is all the acres that the producers around the world find to plant to crops. And this is for the 13 primary crops. And there are a couple time periods that are really worth pointing out. This is the 1970 farm economy boom. We talked about this in Escaping 1980. We went from about 1.5 billion acres harvested to close to, 1.8 billion acres to 2.1 billion acres. This is a demand boom when the global factory expands. And then we got to the 1980s farm financial crisis and farmland expansion paused. And it paused for several decades here. We had all sorts of farm policy programs in here that were trying to sideline acres and get this under control. But in general, once these acres come into production, once we make these investments to make this former forest or this former prairie into farmland, we largely keep it into production. And then, of course, you see the expansion that started in the mid 2000s with ethanol in China, and you see this expansion, and then we hit another pause. And the pause button got hit until 2020. Now, I've actually dove into the data a little bit more. The big prevent plant situation the U.S. had in 2019 is sort of hiding this data a little bit. I look at this at a regional basis. We write about this quite a bit on our site. And if you dig into it, Brazil and the former Soviet Union started their expansions in 2019 and 2018. So they were receiving economic signals long before we were. This trade war caused a lot of disruptions in the signals. And what really happened, what really caused some of this change in fortunes in the US economy so quickly was that the US was holding a large share of the global inventory of grain. So world stocks were working their way lower while US stocks were growing. China was still out buying. They just weren't buying as much from us. We were still exporting, but we were having to really get beat up on our bases to get that grain off the farm in, say, North Dakota or South Dakota, especially for soybeans, or maybe in the Corn Belt in Indiana. We had to take a little beating on our cash basis to get that grain to the new customer. So this global expansion, this tight stock situation has probably started a little bit before we felt it in the US. And you can see this expansion's already underway. And that cat's out of the bag. It's not going back in the bag. So we need to continue to watch this moving forward. Here's a look at actual net farm income. These are adjusted inflation dollars. The orange line is a long run average. This is what we call stable errors in agriculture. Throughout the 90s, we saw farm incomes pretty close to that long run average. Here we also see it in the 60s and 50s. And then here are the few of the booms that we've seen in history. This is where we are today, fourth highest net farm income in 2020, going back to the 1970s. Again, as Howard alluded to, a lot of this were direct farm payments. A lot of this was the government support that helped push that up. 2016 is probably going to go down as one of the worst periods in the farm economy in modern history, but you can see we were a long ways away from the farm financial crisis levels. So we got very severely pain here for a short period of time, but nowhere near that 1980s crisis. Here's another look at these direct payments. And I've been encouraging producers to really step back and say, what's the true economic activity of your farm been? What has been the economic engine like? And so one of the things we're seeing is the farm economy in 2021, net farm income on that last slide is down a little bit, but it's primarily driven by this decrease in direct payments. So the farm economy engine is doing better, but we're transitioning off these ad hoc direct payments and we're moving more to the economic engine, the actual power plant here. So here's going to be a farm policy lesson for you all real quick. The Farm Bill provides $10 to $15 billion, historically speaking, in program coverage. The light blue bar are conservation. Those are pretty steadfast. This is the good old days of fixed direct payments. And then we transition there to ARC and PLC. And as you can see, ARC and PLC ebbed and flowed. They've paid about, on average, the same amount as the fixed payments did. They're just lumpy as to when they come. But as we've talked about and mentioned, these have started to really contract a lot. Now, for 2021, we can see that this supplement and ad hoc, there's always been some form of ad hoc, but 2020 and 2021 was the true ad hoc. CFAP 1, CFAP 2, even the PPP loans are tied up in there. So we should probably have a little asterisk next to this because we counted more than we might have usually counted. In purple, these are the MFP payments. So really, we've been above this $15 billion range for a few years now. and it's all been ad hoc policy. That makes it really hard for producers. Ad hoc is Latin for as needed. So policymakers have chosen not to really write in programs that producers can take to the bank, so to speak, or they can put into their budgets. They've had to sit back and wait. So last August, when we were starting to put together a CFAP 2 program and we hit $46 billion, an inflation adjusted record, all signs looked like when they announced that program, it might not be enough. But when the combination of a lot of ad hoc policy and that commodity price rally that happened independently, right? We made the farm policy decisions when corn was at 320, not at 520. But when those things came together at the same time, we saw this big boom. I think in the long run, expect this to go back to this 10 to 15 billion. In fact, if you look at this, we would have slipped below 10 billion without this supplemental ad hoc. Most of this is that $20 an acre producers received way back in the spring, a long time ago. You can start to see we're actually getting pretty darn low for the traditional farm bill spending programs. They're going to start working on a new farm bill. This is going to be fresh in everyone's mind. I think we have to really keep that into consideration. What does that new farm bill look like? Well, ad hoc programs are going to be what Congress is going to definitely remember, and the big price tag that we've seen. So here's a little bit of look at the budget situation. We've already created a budget outlook for 2022. And as you can see, I think this captures a little bit of that dip in producer sentiment. Our projections are costs of production are going to increase quite a bit. So 2020 is where we're saying the low is about $4 a bushel to raise corn in the Heartland region. The Heartland region is primarily the Corn Belt. And so we've seen cost of production increase by more than 50 cents per bushel as we've moved over the last 2 years. 2021 is a unique year. If you price your fertilizer for this corn crop last fall, you were paying about 10-year lows, about $90 an acre. If you priced it in the spring, it was about 5 or 6 year highs at about $140 an acre. So there has been a big transition. I wouldn't get too caught up as to where 2021 is because it kind of depends on when producers were making their decisions. But we've had a big increase in the cost of production. And the one thing that we expect to happen when we see these farm income booms is commodity prices take off really quickly, and the gap here between the price they receive and the cost of production are the profits. And then over time, the cost of production get up. They creep higher, they follow in. I think commodity prices now for the deferred crop are actually a little bit higher. We've seen these deferred crops come up. Right now, the growing season's coming down. The USDA is making some estimates for the yield. I will say this, it looks like it's going to be tight for corn and soybeans, but a year ago, things were kind of bearish and they got really tight afterwards. So we are getting close to the end of the game, but we're not to the final inning yet. There's a lot of things that can change. We, in fact, just wrote an article on our site, and over the last, there's about a 1 in 5 chance over history of the USDA's error for from August to final for corn being more than 10 bushels per acre. So we're still tight, but the air is still out there. And so you can still see these yield forecasts change quite a bit as we move through the rest of the growing season. So keep that in mind. Here's one cost that's just really going to be plaguing producers. It started last year. It's going to continue. Fertilizer prices. Of course, everyone remembers when anhydrous got close to $900 a ton. This is out of Illinois. It got close to $1,000 in some particular markets. Anhydrous right now is creeping above $600 a ton. It's kind of hard to price fertilizer in the summer because some of it's leftover inventory, some of it's new pricing. The one takeaway I want to really point out to you here is phosphorus. Look at the DAP there. DAP prices have really taken off. This is largely being driven by, I should back up. There's obviously a supply and demand thing. Strong prices, producers are going to use a lot of it to increase yields per acre. That's a big piece of it. But specific to the DAP and MAP markets, there has been some U.S. put in some trade, some tariffs on some of the product coming from Morocco. And so we need to understand how this is going to play out. But there's some trade issues going on here that's actually hurting farmers today in these fertilizer markets. Folks are going to be really looking at fertilizer. We're going to keep updating this data. We'll get some good data here in a few months for the fall. And then there's a bit of a pause there between Christmas and the new year. And the data gets a little sketchy because it's thinly traded, and it'll come in. But really keep an eye on the DAP. I think DAP's one that we really got to keep a close eye on. So stocks to use are the key driver here. Corn on the left, soybeans on the right. If I were to plot what our initial estimate for 2020 was, it was over 20%, right there where that red dot is. When we started the year in 2020, the USDA, with all their estimates, thought that we were going to have 20% stocks to use ratio. Now, this isn't a criticism of their inaccuracies. This is just to tell you how quickly things went. We went from the worst of times to some of the best of times in just a matter of a few months. So we're getting close to the bottom here in these stocks to use ratios. You can see the black line represents the long run average. I want to point out here, these don't really get to zero. This is pretty much the bottom of the barrel, and we can talk about why. But when we start to get to 7% stocks used for corn, it's about as tight as it's going to get. When you get to 3% stocks used, it can go a little bit lower in the USDA projections. But what has to happen next is we have to ration usage. And this is a look at the trend line for corn and soybean usage over the last several years, going back to 2000. I want to point out a couple things. First off, corn usage is already down from 2020 levels. So we've already started this quote unquote rationing. The higher prices are curbing usage. Now, relative to the trend line, we're below the trend line. So I think there could be a little concern for corn usage, especially if these corn yields start to creep up. We've already sort of sent a price signal out there. It's going to take us some time to get some of this demand turned back on if we end up having a bigger than expected crop right now. The other thing I want to point out is someone posted on social media today, why aren't corn prices higher? We're at the bottom of these stocks to use. So we're down here at the low of these stocks to use. Corn prices should be higher. Well, look at 2012. Stocks to use are one element of that component. The other one is how much rationing did we have to do? And look at how much rationing we had to do back in 2012. We had to get somewhere like 1.5 billion bushels of usage curbed. And that's why we had such high prices. So we're sitting here with tight stocks and a little bit of rationing going on the corn side. The other thing I want to point out is look how crummy our usage was for corn in the trade war. This is less corn being used 2 years ago at a much lower price. This is 340 US corn, less usage. Thinking about this demand, we are exporting more corn today than we were 2 years ago at a much higher prices. That is a change in demand. That is a fundamentally positive development for the US ag economy. It's even more dramatic for soybeans. Think about where soybean prices were $8.50. We were flirting really close to that PLC level. And then all of a sudden now we have, $12, $13 cash prices, and we're having significantly more usage. So this is an increase in demand as well. Again, soybean usage is curbed. It's still very strong. Soybean usage last year was an all-time high on two ways. First, it was the absolute high in terms of total bushels out the door. That's kind of a meaningless number to me, but it was also the biggest departure from the trend line. So it was a huge increase in usage last year coming off those trade war slumps. Now, I want to talk about China, and Howard shared a couple of great charts, but I want to share a few others that I think are important. This is the big picture. China has what we call a 100 million acre gap. So since 1990, they've harvested roughly 300 million acres of crops. Remember I showed you the global acreage story, and I told you acres increase when there's a demand boom? Well, it doesn't happen in China. China has some geographical limitations, how much farmland they can put into production. Between the mountains on the west and the oceans to the east, they've tapped out all their resources. And the other chart here is the acres that they need. So looking at consumption, converting it back to production. And as you can see, in the early 90s, they were self-sufficient. They were actually exporting some stuff to their neighbors. Then in the 2000s, they became they remain self-reliant, but just by a thread. And what's happened over the last 10 or 15 years is they've returned to the world for more and more. It's primarily soybeans, but it's starting to spill over into other crops and even into livestock. So right now, they have a 100 million acre gap. Another way of framing this is they rely on global partners, trade partners, for about a quarter of all their grain consumption. This is not a trend that's going to disappear overnight. This is going to be something that is going to stick around for a long time. So I think there's two trends that are probably going to stick around. China is going to be a thorn in the side of every US president for probably the next couple decades. And this is not going to be specific to a Republican or a Democrat president. This is just going to be geopolitical juggernauts butting heads. The other thing that's going to happen is China is going to be reliant on the world for more and more of their global grain consumption. That's going to continue to play out. There are several charts here. You're welcome to screenshot this. And Nolan, I'm going to send you this when we get done so you can share the PDF as well. And there's articles on our website. When people get excited about China, they think of this demand story that we saw in soybeans, right? China was consuming about what they produced in soybeans to the mid 2000s, and then their production stalled. It stayed about 20 million metric tons while their consumption took off. Consumption in 2 decades increased from less than 20 million metric tons to almost 120, a 6x increase in just 2 decades. We don't see that a lot in agriculture. How did China do it? Well, look at the green line. China went from buying essentially no soybeans in the early 90s to buying 60% of all the globally traded soybeans. Okay, where are we at for corn? Well, corn, China came in and caught the world by surprise. They bought a lot of corn. We weren't even thinking about corn a year ago, and they came in and they bought a lot of corn. They bought about 13% of all the globally traded corn. You can see in the past, they have made corn purchases around 2012 and in the mid 90s. These have kind of represented when the world gets concerned about stocks, China wants to add a few more stocks to their inventory. I don't know what's going on here, but they made some big purchases. We wrote a lot about this. One of the data trends that I don't think is getting talked enough about is look at what China's corn consumption has done relative to its production. And if you keep digging down into the data, and we've done this, they have not increased their acreage. So what's happened, what's driven most of this increase over time is they've added more corn acres. They stopped adding soybean acres. They moved soybean acres out of soybeans into corn. But over the last 5 or 6 years, they have stopped adding corn acres. So they're only relying on yields. And this is not to say that China can't increase their yields. They're going to make huge investments in there, but their demand is outpacing what they can keep up with just yields alone. 2 other charts I want to point out. Beef has a very similar trajectory that soybeans had 2 decades ago. We see consumption outpacing production, and you see them coming in and buying a third of all the beef around the world. In fact, they bought 12 times more US beef in the first 6 months of 2021 than they did in the first 6 months of 2020. They've been coming to the US for a lot of beef. The other thing here is China's been buying a lot of pork, but that is a supply issue. That is the African swine fever that has been forcing them to buy from global trade partners a lot. But also the African swine fever is still moving its way around the world. I don't think we've seen the end of African swine fever. In fact, I think COVID kind of kept African swine fever at bay. As people traveled less in 2020, so did the African swine fever. So we got to keep an eye on that as we move forward. I'm just going to make a couple quick comments about rent. Here's a few different slices of the data. The one thing I want to point out, this is the cash rent for average quality farmland. It's moved here a little bit, as Howard noted. It's getting close to those 2013 highs. But I want to point out on a per bushel basis, so over the last 10 years, yields have kept creeping higher, 1.7 bushels per year. And that's kind of chipped away on the cost per bushel. So on one hand, people say, oh, we're getting close to those 2013 highs. The farm economy isn't nearly as good as it was then. It's pretty darn good, but you're right, it's not as good. Well, let's look at what's happening here. On a cost per bushel basis, the increase in yields has chipped that away quite a bit lower. So we think there could be a lot of upward pressure here as producers start to think about what's my cost on a per bushel basis. I might be able to bid this up a little bit. We have this tool called the Ag Forecast Network, and we try to help, thought leaders really think about uncertainty in a structured way. We have a sort of, as humans, a flawed way of thinking about uncertainty. So a year ago, we said, or back in January, we said, we think farmland values are going to be up. And we asked the group, what do you think the probability of farmland values increasing by more than 10% out of that Purdue farmland survey year over year? And as you can see, back in January and February, there was a pretty low outlook, about 40% probability. And as the commodity prices, as the budget situation crept higher, this got closer to 75%. And I don't have this chart updated, but here's what a 14% change in farmland values looks like. As you can see, during those boom years, 15, 20% movements are very common. So farmland moves a little more than one might initially think about, especially during these boom eras. I'm going to switch gears here and talk about the macro economy. Not only is the farm economy in a unique situation, the macro economy is in uncharted territories. Not only was the pandemic uncharted territories, but all of our stimulus efforts and the recovery is uncharted territory. One thing to look at, this is actual GDP, not percent change, but actual gross domestic product. And if you just kind of draw a line into the future, you can see we're making a pretty strong recovery. If you trajectory, we're maybe going to start to approach the economic growth we had before the pandemic, but we're also sort of back to pre-pandemic levels. Contrast this to what happened during the Great Recession. We never got really back to that trend line that we had pre-pandemic. or pre-financial crisis. And then look how long it took us to recover. We were well into 2011 before we got back to the economy back on track. This economy has been recovering pretty strongly, and that's been a combination of the nature of the disease, but also the nature of the recovery. One thing that's very unique is we were able to inject stimulus as the cases of COVID became known. Back here, the recession started, in early 2018, but we didn't know it until Lehman Brothers started to fail, right? And right before the election. It wasn't until the fall that we really knew the US had a recession on its hands. We knew the recession was going on right as soon as before even the economic data from the Fed was available. The other thing I want to point out here is this is the deficit as a share of GDP. This is something that policymakers, especially when we get to the new farm bill, are going to have to deal with at some point. As you can see, the deficit is pretty challenging. You can remember all the chatter about deficits and sequestration that took place when we negotiated the farm bill back in 2014, and we're sort of a cakewalk back then compared to where we are today. The other thing I want to point out is the deficit was trending unfavorably all the way back until 2016. So we don't not only have the spending issue associated with the pandemic, which could be argued as a one-off investment, right? But we also have some challenges with the tax code that led to this deficit increasing long before the pandemic hit. I think the other thing that we want to keep in mind is the debt situation. It's been growing a lot. We also have a lot of stimulus coming out of the Federal Reserve. The headline career low interest rates has been relevant for at least a decade, right? And it's been continuing that way at the farm level, but also the Federal Reserves, they dropped their rates to zero, but that wasn't the end of their work. And as you can see, they've added assets long since they've dropped the rates to zero to continue to keep the debt markets working. Now, I'm going to wrap this up by just talking a little bit about the word inflation. And if someone tells you they know what's going to happen for sure with inflation, they're lying to you. There are very smart people on this screen, and they all have very different opinions. Even people who have the same political stripes don't agree with what's going to happen with inflation. And there's a lot of things. And I think people use the word inflation as a scare tactic. And so this is some of the data we watch with inflation. And I always say, what do you mean by higher inflation? Are you talking about these 10% levels that we saw in the 70s? Are you talking about, the levels we saw in the 90s or the 2000s? Arguably, the Fed thought that we had too little inflation over the last 10 years. Too little inflation was probably a challenge for the economy over the last decade. And now we're getting close to maybe 3.5%. These are monthly data, so don't get too caught up about this blip higher. We need to see that persist for a while before we actually peg this in. I'm a little concerned about inflation, but there are three questions: how soon, how much, and for how long. I'm not concerned as I think I'm less concerned than most about getting to double-digit inflation. However, I am more concerned than most about a reality of inflation around 4% that persists for 10, 15 years. That will be structurally very different than the sub 2% we've saw for the last decade. So inflation is going to be tricky, and we have to be specific with how we think about it. Three other factors I'll mention real quick and turn this over. I know we're out of time. Labor issues are going to be a challenge for producers and everyone in the economy. I think we've all been to a fast food restaurant that said, sorry, we don't have enough workers. Supply chains are going to be a problem. I got a long story about my dad trying to buy tires, and he couldn't get the truck tires that he wanted, and he's all bent out of shape. And planter parts, couldn't get the planter parts they needed. But we're seeing a shift from just in time to just in case. And then the final piece here, carbon mania has been everywhere. A lot of talk about carbon markets, the potential impact for farmland values. I think it's too soon to really know how all this is going to come together, but put that in the back of your mind. Start thinking about how these programs are going to come together. I actually think the Farm Bill is going to have a heavier hand in conservation and trying to incentivize some practices that maybe don't make for good carbon markets, but are still good for the environment. So I'm going to stop right there, Nolan, and turn it back to you. Happy to share the slides or answer any questions that we have at this point.
Thank you, Dave. That was excellent, as always. These guys, he and Brent do a tremendous job. I get their weekly emails, and as you saw in my presentation, there's a variety of things I find very interesting and things that they track. And I would highly recommend you go on to aei.ag and see what you can glean from there. So we really appreciate Dave joining us today. I think his insights really dovetail in with mine, and Great comments on inflation. Yeah, I think if you look at hyperinflation, which is that double digit, farmland isn't always really correlated well with that. It's more of that steady inflation. So I'm not a big fan of inflation for a lot of other reasons, but historically farmland has done reasonably well with it. So we shall see. Again, thank you all. I know we're a little past the hour. Thank you for joining us today. I think we have in the chat, I've got some folks that have sent in where you want the PDFs. If you've got more of those, we'll leave this open for a little bit and you can go ahead and send those into the chat. I had some communication while Dave was presenting with some other discussions about what cash rent should be. And I just want to throw that out. Every farm's unique, every area is different. So what I'd like to do is if you want us to take a look at a rent situation for you, glad to do it. And one of our staff members in your area would reach out to you and have that discussion. So again, just send us a phone number or an email and we can make the connection and take it from there. So thanks again, everybody, today. And with that, we'll sign off. Any other questions anybody has? Nolan?
No, but we are going to leave this up so that everybody can send in their emails and we'll get those sent out.
Fantastic. Dave, thank you again. Have a great rest of your day and be safe out there.